Module 2, Intro to Funds. Now, what is a fund? The word fund in the financial world just means a pool of money. Investment brokerages offer the chance for investors to contribute to a fund, which holds multiple different stocks. You buy them the same exact way as you would stocks through an investment app. The point of a fund is to allow investors to invest in the market without picking individual stocks, which is 10 times riskier. Early beginnings and evolution of funds. Now, I'm not about to read all this. You can read all this if you want to. I'm just going to read the first paragraph, but you can do whatever you want. The story of investment funds begins in the 18th century with Dutch merchants. They pioneered the idea of pooling resources to finance overseas trade ventures in response to the financial crisis of 1772 through 1773. This collective approach laid the groundwork for modern investment funds, allowing investors to share risk and reward. In simple terms, funds are investments on the stock market that are able to be purchased by everyday investors like you and I. Different investment types like funds, stocks, bonds, etc. are offered to investors. Funds specifically help regular everyday investors invest in the stock market. Investing your money in a single stock can be risky, as any company at any time can deliver bad news to its shareholders and the price could drop faster than you can react. But if you buy a fund which has multiple different stocks in it, any one company that's in that fund could go bankrupt, and the rest of the companies can protect your losses and the fund will remain intact. To buy a fund, you can log into your brokerage account and buy them. A brokerage account is just an account with a brokerage firm that allows you to invest in the stock market. Funds have ticker symbols just like stocks and can be searched and found within your brokerage account. Now, just to reiterate, funds are not companies on the stock market. They are just holders of different companies. So you cannot search for financials and revenue and stuff like that. You will have to look at the companies inside and decide if it's a good fund to invest in. Now we'll talk about this process a little bit later. There are three main types of funds: mutual funds, index funds, and ETFs. Mutual funds are investment funds that are actively managed, meaning there is a professional fund manager managing the day-to-day investments within the fund. A fund manager is essentially a person that works at an investment firm who's trying to make trades according to the investment philosophy. Their goal is to beat the big three stock market indexes so that clients can be attracted to their firm. Index funds are investment funds that are passively managed, meaning there must be a certain criteria met in order to make investments within a fund. So instead of it being a person who manages the investments within a fund and makes decisions based off his own tuition, a criteria basically runs the fund. Investments will automatically and only be made if that criteria is met. For example, an index fund that tracks the S&P 500 index will only make investments when the S&P 500 committee makes changes to the index. A change in the index could be them taking out companies and adding companies in. The index fund would make the same exact changes to match the S&P 500. Exchange traded funds, or ETFs, are investment funds that can be passively or actively managed and is allowed to be traded on a stock exchange just like stocks. So ETFs are just like index and mutual funds, as in the sense that they can be invested in by the average investors like you and I. The only difference is that with ETFs is how they trade. They trade like stocks. So that means you can day trade them and do options on them. Day trade just means that you can repeatedly buy and sell shares of stock in any given day to receive a profit. Mutual and index funds do not allow you to day trade them, and we'll talk about why later. The controversy surrounding mutual funds is that they are actively managed by a fund manager. Besides charging outrageous fees, fund managers make trades on a day-to-day basis or whenever they think they should buy or sell a particular stock. The main concern with this is that as humans, fund managers may make mistakes by getting too emotional or getting too cocky. Although some managers may get lucky and beat the big three stock market indexes, 80% of them will fall short and underperform. Index funds are the polar opposite of mutual funds. Trades are only made under predetermined criteria. Before an index fund is created, they're set to follow a certain criteria. If this criteria is not met, investments within a fund will not be made. As simple as that. This is a better alternative to mutual funds, as the human emotion element is taken out of investing. Emotion is the number one reason why investors fail. Index funds outperform mutual funds by a landslide. Funds that track the S&P 500, for example, have returned an average return of 10% per year since inception. The S&P 500 was created in 1957. That's almost 70 years straight of 10% gains per year. Sometimes it's 20%, sometimes it's negative 10%, but on average, over the last 70 years, the S&P 500 has returned 10% per year. ETFs are exactly what the word says. They are funds that are traded on a stock exchange. Index and mutual funds are offered through your brokerage account and cannot be traded on a stock exchange, meaning they are not constantly being bought and sold throughout the day. ETFs are the exact opposite. Index and mutual fund stock prices only change once a day, meaning you will only see your fund stock price change at the end of the trading session, which is 4 p.m. every day. ETFs, however, they trade like stocks, meaning you can buy and sell them an unlimited amount of times per day. You can do options on them, etc. Now, what does all of this mean? All right, so let's go over a couple things. Stocks, index funds, mutual funds, and ETFs have something called an opening price and a closing price. The opening price is the price at which the fund starts trading at for the day. The closing price is the price at which the fund closes at the end of the day. With index and mutual funds, because they are not traded on the stock exchange, the only share price you will see is the opening and closing price. You will not be able to see a constant share price change throughout the day as you would with stocks and ETFs. This is because stock exchanges have tens of millions of shares being traded at any given time, while funds are handled directly through the brokers that offers them. With all three types of funds, you can log in and buy any of them when the stock market is open. The only difference between ETFs and the rest is that you can constantly buy and sell them throughout the day at whatever price it is at that second. But with index and mutual funds, you can still buy them at any second. You just will be buying it at the closing price at the end of the day. And if you want to sell it, you'll be selling it at the open price in the morning. When the market closes, the fund's daily performance is calculated. They calculate this by the performance of the companies inside and how they perform for the day. The closing price is the price at which everyone's shares will be ordered at if they want to buy. Index funds and ETFs can track the same exact benchmark and give you the same exact returns. They're just bought and sold a little bit differently.